Welcome to this week's episode of Jonathan on Money. This is episode number 174. I promised listeners last episode that I would provide a recap of my experience to Cartwright in Monticello this past weekend. For folks who don't know, Cartwright is an indoor water park with a hotel attached. For background, I don't normally go on trips like this. I'm more of a road trip enthusiast. However, what I will say is that we had a great time. Lines were not too long, and we went on every ride, and my kids really enjoyed themselves. Also, kosher food is just a short 10-minute drive away, at least during the summer months, and they have some phenomenal options. In particular, Tom Eden is a bakery with awesome bread, sandwiches, and of course, pastries. Hasidic people just do baking better than the modern Orthodox style that I'm used to. I know some listeners may be offended by that, but it's just the truth and the reality. I also found a minion in the hotel for Friday night and Saturday night for Shachrit and Shabbos Mincha. You can walk to a nearby bungalow colony if you so desire. All in all, this was a very positive experience, and I'm glad I did it. Also, it didn't hurt that the ride to visiting day on Sunday was 20 minutes instead of 2 hours from my house. So, worth considering for all those listeners out there. In other news, don't forget to buy my book, D's for Diversification, the ABCs of Personal Finance, which is now available on Amazon or at jonathanmoney.com. And buying this book is still a wonderful way to support this podcast. And finally, before jumping into this week's episode, I'd like to share that my upcoming live fall webinar series will be released in a few weeks. It's really coming together nicely. I have a great list of speakers. If you or a friend would like to be notified of my upcoming series, you can either go to parkbridgewealth.com/webinars and register to be on my webinar distribution list, or just email me with the word webinar in the subject line to be added to the list. Okay, now for today's agenda. My talking points this week will discuss Elul in your portfolio, what the month of reflection teaches us about money. Our quote this week is from Benjamin Franklin about financial leaks. I'll spend the last half of the episode answering listener questions, including setting our kids up for our 6 kids up for financial success. And finally, we'll end with an actionable idea to implement your investing life, where we'll discuss avoiding big tax bills for mutual funds that lost money. With that, let's jump into this week's talking point. So, Elul arrives quietly. There's no dramatic mitzvah that announces its start, no single ritual that defines it in the way the shofar defines Rosh Hashanah, or the fast defines Yom Kippur. Many families are still in summer mode, weeks away from the deadlines and busyness of the fall season. Elul asks something subtler of us, introspection, to notice where we have drifted and begin walking back before the day of judgment. That approach, honest review followed by patient correction, is also some of the best advice any financial planner can give a client. Cheshbon HaNefesh, the accounting of the soul, and Cheshbon HaKesef, the accounting of one's finances, run on nearly identical logic. The Rambam describes the work of this season as a genuine audit of habits, patterns, and blind spots, not a ceremonial gesture. A person is meant to look clearly at who they have become over the years, neither flattering themselves nor being unnecessarily harsh. This same clarity is missing from most people's relationship with their money. Few of us ever ask whether our investment allocation still matches our goals, whether our spending reflects what we want, what we say we value, or whether fear and impulse have been driving decisions we would never defend out loud. A portfolio review conducted with the same honesty we bring to a spiritual review during Elul can be eye-opening. It's not about self-flagellation, I love that word. It's about seeing clearly which the Musar tradition treats as a prerequisite for real change. One lesson of Elul is that transformation rarely comes from a single dramatic gesture. It comes from daily incremental effort, a few extra minutes of slichot, a short moment of reflection repeated night after night. This same principle governs sound investing far more than most people realize. Raising a retirement contribution by a single percentage point, updating outdated beneficiary designations, rebalancing a drifted portfolio, or automating monthly savings all feel almost too small to matter, yet compounded over years, these modest adjustments tend to outperform the dramatic headline chasing moves that most investors mistake for meaningful action. Every year, I check in with my clients to determine if any changes are needed in their strategy. These changes are almost never drastic. They tend to look like the small modifications that I just noted before, saving a bit more each month or adjusting stock exposure modestly. Consistency beats intensity in the long run. It's true during Elul, and any actuary or financial advisor would tell you the same thing about a retirement account. Next is that Judaism does not expect anyone to arrive at Rosh Hashanah unprepared. This is precisely why Elul exists, a buffer of preparation before the moment when preparation is no longer possible. This logic translates directly into risk management. Emergency savings need to exist before a job is lost. Life insurance needs to be in place before an illness is diagnosed. Estate documents need to be signed before a family is thrust into crisis. Diversification needs to happen before markets turn volatile. In nearly every case, preparation costs far less than the emergency it is meant to soften. This kind of preparation matters most when life throws an unexpected curveball. In the age of artificial intelligence, I've been seeing more clients in their 50s and 60s lose their jobs before they're ready to retire. The clients who fare best are the ones who spent years building a nest egg. They have cash reserves to carry them until they find new work, even at a lower salary, without upending their broader financial plans. Elul's entire premise is that foresight is a form of wisdom, and the financial world rewards that same foresight with real measurable outcomes. There's also controlling the controllable. During Elul, we are not asked to predict what the coming year will hold. We're asked to work on ourselves regardless of what the future brings. That distinction matters for investors who often waste energy forecasting interest rates, elections, or the next market swing, all things entirely outside their control. What remains within investors' control is more modest and more powerful. How much they save, how their assets are allocated, how efficiently they manage taxes and costs, and whether they stay emotionally disciplined when markets turn frightening. Long-term success has more to do with mastering these controllable variables than with any gift of prediction. In a world of around-the-clock news, much of it is designed to drive fear and clicks. Stepping back to understand what is in your control is essential. The latest nerve-wracking headlines will fade, but some long-term decisions about your money will have a lasting impact regardless of what dominates the news cycle. We are not judged in life or finances on whether we correctly guessed the year ahead, but on whether we did the work in front of us. There's also the theme of measuring yourself against yourself. Elul calls each person to examine their own life, not measure themselves against a neighbor. This is one of the more demanding aspects of the month. Comparison is a constant temptation, especially within the frum community, but can be corrosive spiritually and financially. A financial plan built around the neighbor's vacations, a friend's home renovation, or a colleague's investment returns has the wrong foundation. Comparison tends to push people toward overspending and speculative decisions they would never make if they simply ask what their own life requires. A sound plan reflects one's own goals, family obligations, risk tolerance, and values. There's also teshuva as a course correction. Teshuva is often misunderstood as an exercise in guilt. It is, in fact, a structured process with clear steps, recognizing the problem, stopping the harmful behavior, building a plan, and committing to a better path. This is essentially the same process behind sound behavioral finance. Overspending, chronic undersaving, or speculative trading are not stopped through willpower alone. It requires a concrete plan, backed by automation, accountability, and the guidance of a trusted advisor. Teshuva is not a single and emotional moment. It is a method, and it happens to be an excellent one for fixing a financial life that has gone off course. Another central theme of Elul is repairing relationships with Hashem and with people around us. Money properly understood is meant to serve that same purpose. Conversations about inheritance plans, honest discussions with a spouse about shared financial goals, teaching children responsibility, money habits, and intentional charitable giving are not administrative tasks to check off a list. They are relationship building in a financial form. The Talmudic instruction to divide one's assets into separate portions is often cited as the earliest articulation of diversification, but it also reflects a broader Jewish view of money as a stewardship rather than pure ownership. Wealth exists to strengthen a family and a community, not to serve as a private scoreboard. In my own home at this time of year, my wife and I set aside time to discuss where our remaining philanthropic dollars will go before year end. That conversation is about far more than money. It is a yearly check in on which causes we want to support and whether they will still align with our values. And here's a closing thought, perhaps the deepest lesson of Elul, one that comes up often in my writing and in my speaking, my podcast, is that success rarely comes from a single dramatic moment, but from years of consistent habits, honest reflection, and behavior that stays aligned with one's value even when no one is watching. Elul can serve as a natural yearly checkpoint, not only to ask how one has grown spiritually, but also whether the resources Hashem has entrusted to us are managed in a way that reflects our priorities, protects our families, and allows us to do more good in this world. That question, asked honestly every year, may be one of the truest forms of stewardship there is. Okay, those are the talking points this week. And as a reminder, you can be notified of all my recent articles, webinars, and all the work I put out by subscribing to my free monthly newsletter at parkbridgewealth.com/newsletter. This week's quote is from Benjamin Franklin. For those who don't know, Benjamin Franklin is one of America's most influential founding fathers. Born in 1706, he became a printer, writer, inventor, diplomat, and statesman. He helped draft the Declaration of Independence, negotiate the alliance with France during the Revolution, and contributed to the U.S. Constitution. Franklin was also a prolific inventor, creating the lightning rod, bifocals, and the Franklin stove. As a scientist, he conducted groundbreaking experiments on electricity. His Poor Richard's Almanac offered practical wisdom that shaped early American culture. Franklin's blend of curiosity, public service, and innovation made him a defining figure in the nation's early development. He's also my personal favorite of the founding fathers, and if you haven't seen the Ken Burns documentary on PBS with Ben Franklin, I highly recommend it. Franklin once said, "Beware of little expenses. A small leak will sink a great ship." Though a $5 coffee here and there or six or monthly streaming services may not seem like much, small purchases can quickly add up. While it's easy to keep your larger expenses in check, it's not so easy to count at all the small everyday expenses. The takeaway: those little expenses add up and can quickly put a dent in your wallet. This is why having a budget is so important. To keep yourself in check, evaluate your expenditures every month, and try to cut back on any miscellaneous unbudgeted expenses. I always tell people to do at least an annual review of their credit card bills to look at where all their money is going. A few dollars a month spent on a variety of services you don't actually use can cost thousands or tens of thousands of dollars a year. Get control of those small financial leaks, and it can make a big difference in your life. Okay, now let's jump into this week's financial questions. And if you do have a question, feel free to submit it to me and it may be answered in a future episode. Okay, first question: what is a term premium in the bond market? So I see we're starting out this week with a bang. The term premium is the extra yield investors get for holding a long-term bond instead of repeatedly investing in short-term bonds. It compensates them, the investor, for risks that grow with time, especially uncertainty about future interest rates and inflation. A long-term bond's yield can be thought of as two parts: the market's expectation of future short-term interest rates, and the term premium, which is the additional return investors require for locking up their money for longer. When the term premium is positive, long-term yields rise above what short rate expectations alone would suggest. When it is negative, investors are willing to accept lower yields, often because they value the safety or liquidity of a long-term government bonds. The term premium matters because changes in it can move long-term interest rates even when expectations for short-term rates stay the same. In essence, it reflects how much compensation the market demands for uncertainty over time. Okay, next question. What is a 351 exchange ETF and how does it work? And the excitement continues. A 351 exchange ETF is a way to move appreciated stocks into a new ETF without immediately paying capital gains tax. Normally, if you sell a stock that has gone up in value, you owe taxes on the gain. A 351 exchange allows you to contribute those stocks directly into a newly created ETF instead of selling them. In return, you receive shares in the ETF. Because of a rule in the tax code, section 351, This transfer is treated as a tax is tax deferred, which means that you don't pay taxes at this time of the exchange. Your original cost basis and holding period carry over into the ETF shares. You'll only owe capital gains taxes later when you eventually sell the ETF. This strategy is especially useful for investors who are sitting on large, concentrated positions with big unrealized gains and want to diversify. Once inside the ETF, your holdings become part of a broader, professionally managed portfolio, and you benefit from the general tax efficiency of ETFs. However, there are rules to be mindful of. For example, the contributed asset must meet diversification requirements, and the founding investors must collectively own at least 80% of the ETF at launch. Highly concentrated single stock positions usually don't qualify unless combined with other assets. It's important to understand that taxes are deferred, not eliminated. This strategy also requires coordination with an ETF sponsor and tax professional. For the right investor, a 351 exchange ETF can be a smart way to diversify without triggering an immediate tax bill. All that being said, you are not the right investor for this, and I can say that without knowing anything about you, but I assume you don't have nearly enough money, time, and patience to deal with this process. Diversify out of a concentrated position the old fashioned way, sell it over time, and give some to charity. Next question: at what level of wealth do you have a family office? I recently sold my business and was curious. First person you should call if you have family office level wealth is Jonathan I. Shenkman. That's step number one. Now, for some background for folks not in the know. For those who don't know, a family office is a private organization that manages the financial, investment, and personal affairs of the ultra wealthy families. It serves as a centralized hub designed to preserve and grow wealth across generations while coordinating tax and estate planning, risk management, philanthropy, and family governance. Investment oversight spans public markets, private equity, venture capital, real estate, direct deals, manager selection, and risk monitoring. Family offices also handle complex tax coordination across entities and jurisdiction, manage trusts and generational transfers, and implement asset protection structures to guard against lawsuits and creditors. In terms of asset level, a family office becomes relevant once a family's wealth reaches a level where financial complexity, coordination, and privacy needs exceed what a traditional advisor can reasonably manage. A dedicated single family office generally requires at least $100 million dollars in investable assets to justify the cost, with more fully staffed version often beginning $250 million dollars, and the most comprehensive structures typically associated with over $500 million dollars. In other words, it's my typical client size. On the other hand, multifamily offices offer a more accessible asset threshold, usually around 20 million, while virtual or outsourced family office models can work for families in the $10 million range. Before setting up or hiring a family office, first figure out your needs and then determine what type of wealth management setup makes the most sense for you. Years ago, I had a series of meetings with a family office about investments that they were interested in. There are many people working there, all with fancy pedigrees, trying to get an edge for their client on the best investments. They invested in the most exotic stuff you could imagine. Remember, just because you're uber wealthy does not mean you need fancy investments or fancy infrastructure. Stick with the basics and have a few sophisticated advisors, and most people will be fine with this setup. Next question is: my broker earns me about 11% annually over the past few years. The problem is the taxes I pay on an ongoing basis. Would I be better off in a triple tax-free municipal bonds, which were recommended by another broker? Do you want to earn low digit returns in tax-free municipal bonds that will lose buying power to inflation, or would you rather outpace inflation over the long term and pay taxes along the way? You can have it both ways. Taxes are the price you have to pay to make money. Sorry to break that reality to you. What the other broker is selling you sounds good because he is promising no taxes. However, every decision has trade-offs, the part which is the part he left out. Low returns and not making money means no or low taxes. Making money and high returns will end up with a bigger tax bill. Pick your poison. Next question. My husband and I have 6 kids and would like to pay for weddings and set aside funds to give our kids a financial runway to be able to learn for a few years after marriage. The challenge is we're both teachers with modest incomes. How do you recommend we give our kids the support they need while we aren't neglecting our retirement planning? So this Shiloh reminds me of a quote I heard years ago and now use quite often. You can have anything, but you can't have everything. If you're a teacher making a modest living, you need to establish your priorities since you don't have enough money to do everything. The truth is that saving for your retirement is far more sensible decision. It's responsible and essential to your life to set aside funds so you can eventually retire. If you don't plan ahead and save money, you will need to depend on your kids, and that is a very precarious situation to be in. This habit of saving and investing will also be modeling behavior for your kids that if they want something, they need to work for it. I feel like this question comes up way too often. I just don't understand this whole learning after marriage while someone else sponsors your lifestyle shtick. Didn't that happen already? It was called Shana Aleph and it took place a year after high school. What is this post marriage learning nonsense? When did this become a thing? Can't your kid learn and find themselves on their own time and dime? In ancient times, every rabbi had a profession. Hillel worked as a woodcutter, Shammai as a builder and a surveyor, Rabbi Yoshua ben Hananiah as a blacksmith, Rabbi Yochanan ben Zakkai as a merchant, Rabbi Meir as a scribe, and Rabbi Yishmael as a temple official. Rabbi Yehuda Hanassi was unusually wealthy and supported by extensive estates and Roman connections. You always got to be networking. Among the Amoraim, Rav was a farmer and landowner. Shmuel was a physician and an astronomer. Rav Chisda worked as a brewer. Rav Papa was a beer manufacturer and businessman, which is a great combo. Rav Yochanan served as a teacher and judge. Rava was an entrepreneur and landowner. And Mar Ukva served as the chief justice of the Exilarch's court. Unless your children are chas v'shalom disabled or unable to work for other serious reasons, then you should save for retirement, tell your kids that the honeymoon is over, kick them off the family payroll, and they need to get a friggin' job. Why do I hear so many personal finance podcast hosts and bloggers promoting an hourly fee model for financial advisors, but it's impossible to find someone who actually charges that way? Many podcasters and bloggers promote hourly financial planning because it supports their business model. They make money selling courses, books, and other products. If you hire a full service advisor who manages your portfolio and implements your plan, you are far less likely to buy what these content creators are selling. Promoting hourly planners keeps their audience engaged and preserves their ability to market products. The hourly model itself is also flawed for most families. Paying someone for a few hours of advice each year often leads to little or no implementation. Without ongoing management, accountability, and monitoring, even good recommendations rarely translate into real world results. It is also not a lucrative business model for advisors. Top advisors gravitate towards percentage based wealth management because it allows them to serve clients deeply and build sustainable wealth. Wealth management is a for-profit industry, and the market consistently rewards high-touch service and ongoing guidance. If you choose to work with an hourly advisor, do thorough due diligence so you understand exactly what you're getting and whether the advice will truly meet your needs. Or if you prefer, you can always buy the podcaster's course. At the end of the day, it's your world, and we're just living in it. Next question. People on TV are discussing a K-shaped economy. What does that mean and how does it impact me? A K-shaped economy describes when different parts of the economy move in opposite directions at the same time. Some groups advance quickly while others fall behind. The term became more well known during COVID when the gap between economic winners and losers became especially visible. The image of the letter K illustrates this split. The upper arm represents individuals and industries experiencing growth, while the lower arm reflects those facing stagnation or decline. After the pandemic, technology driven companies such as Amazon and Apple benefited from rapid digital adoption. Meanwhile, workers in hospitality, travel, and brick and mortar retail faced layoffs, reduced hours, and slower wage growth. The reason why a K shaped pattern gets a lot of headlines is because its effects are usually structural when forces like technological change, globalization, or monetary stimulus disproportionately benefit high skilled labor. Rising stock and real estate markets can boost wealth for investors, while those without meaningful exposure to financial assets may see little improvement. The significance of a K shaped economy is it gives news networks something to fetch about and rile up their audience about. Income inequality, boo-hoo, as if this is a new concept. It's not. There will always be, there's always been income inequality, and there always will be. The thing is, we live in a meritocracy. Put in the work, ignore the naysayers, be blessed with a little mazel, and you too can make it to the upward sloping part of the K curve. Don't worry about the talking heads or what the talking heads are saying on TV. You do you. Next question. I lost my shirt on Bitcoin in the latest drop. What should I do? Well, first, shirts are overrated, so I wouldn't worry too much about losing it, but I digress. I really don't know what you should do, Hefe. I never invested in Bitcoin and still don't understand it, but I don't want to leave you hanging, so here are some thoughts. If Bitcoin was a business or commodity, then I would suggest buying the dip. Sadly, it's neither. Therefore, it's really just pure speculation. Since it's literally the definition of gambling, then it belongs in your cowboy account, which shouldn't make up more than 5% of your investable assets. If it is below this 5% threshold and you still feel confident in Bitcoin, then perhaps you should buy the dip. If this position makes up more than 5% of your investable assets, then perhaps just stay the course and hopefully it will bounce back. If this is your approach, then I would recommend selling a shtickle Bitcoin at predetermined prices so you can minimize your position slowly without losing yet another shirt. Another option is to sell some or all of the Bitcoin today and use the losses to offset gains in other parts of your portfolio to minimize your tax liability. After all, paying taxes is so mid. Best of luck, brah. Next question. I always get my 1099s in mid-February from my various investment accounts. It's dumbfounding to me how unprofessional these firms are that they are not sent out ASAP on January 1 so people can actually file their taxes on time. Any ideas why it takes so long? I am dumbfounded by how uptight you are, dude. The middle of February? Relax. The reason why it takes time for 1099 to be generated is if you have different mutual fund or ETF holdings, each company that owns these products needs to provide the relevant tax data. Then they send it to the broker dealer where you do business. It may take time to calculate, process, and get the info to your firm and then package in your 1099 and generated for your accounts. I'm not saying it can't happen quicker, but it's not as simple as snapping your fingers. Some institutions can get it done quicker depending on their types of products. It also may depend on what you own in your account. For example, most individual stocks holdings may be quicker than owning funds. It takes even longer with alternative investments that may not generate their tax documents until after April 15th, so you need to go on extension. I promise that your taxes will get done this year and every year, and the government will get its money. Just maintain the proper expectations, i.e., that it will take a few months to get your 1099s, and maybe you can avoid having a freak attack next year. Anyway, enjoy future tax seasons. May they be everything you dreamed of and more. Okay, that's it for financial questions this week. And by the way, if you have a more involved personal finance situation, feel free to reach out directly to me via email. My team and I can help you. The best way to get a hold of me is via email at jonathan@parkbridgewealth.com. And finally, I'd like to end with a timely national idea that listeners can implement to their own financial lives. Today's timely topics, continuing on the theme of tax traps to avoid. In particular, we're going to discuss the scenario where your mutual fund just sent you a tax bill for a year you lost money. If you've ever opened a 1099 and found capital gains distribution on a fund that actually dropped in value that year, you felt this one. It happens because the fund manager sold winning positions inside the fund and the tax bill gets passed to everyone holding the shares regardless of when they bought it. Let's say you have a $150,000 position in an actively managed fund and it distributes a 6% capital gain, which is a fairly ordinary distribution in an up market. That's $9,000 in gains landing on your return and at a 15% capital gains rate, a $1,350 tax bill on a fund that may have actually lost value during your holding period. ETFs are structured to largely avoid this, as are passive index funds. If you're holding actively managed mutual funds and taxable account, check whether the same strategy is available in ETF form or move that holding into an IRA or the distribution doesn't matter. And with that, it's a wrap for this week's show. Any comments or questions, feel free to reach out directly to me via email. I love hearing from my listeners. And finally, the secret to financial success is no secret at all. It's to spend less than you make, invest the difference prudently, and ignore all the noise. See you next time on Jonathan on Money.